Most economists I surveyed were expecting a 25 basis point hike or even a 40 basis point hike. So I guess going for a supersized hike shows the Reserve Bank is really worried about the current inflation levels, which is around a 2-decade high. So key to the reasoning of the Reserve Bank's decision is that inflation has gone up significantly to this point earlier than expected. So essentially the RBA was surprised at how quickly the cost of living has risen. So it's blamed global factors like the war in Ukraine and COVID related disruptions in the supply chain, but there are also domestic factors at play, Casey. So the Reserve Bank says the tight labour market is a factor, given the unemployment rate is at a 48-year low of 3.9%. So that's leading to higher wages and goods becoming more expensive, getting passed on to the final consumer. And also the Reserve Bank said the floods, especially on the East Coast, was a factor leading to the higher inflation, and that's caused supply shortages. Now this graph shows the dynamic, the economic state of play that the Reserve Bank has to consider, and it's really complicated. So as I mentioned, unemployment at 3.9%, around a 5-decade low, whereas the cost of living, now that's the purple line, has hit 5.1%, its highest level in 20 years. The RBA wants to bring that way down, and complicating things, wages have only gone up 2.3% in the past year, not enough to keep up with the cost of living. So back to the Reserve Bank's reasoning, it expects in the short term inflation to get even higher than 5.1% due to the high gas, electricity and petrol prices we're seeing. And its longer term outlook, it reckons that inflation will fall back towards the 2 to 3% mark next year. And that's when we expect wages may finally keep up with the cost of living. So in summary, the cash rate now at 0.85%, so it's back to pre-pandemic levels, and that's what the RBA wanted to signal. So it's the end of the era of ultra-low rates and the flood of cheap money, it's over. So the RBA is also not providing any hints about what the next rate hike might be. In its statement, it says the timing and size of the future rate hikes, they'll be guided on the data. So they'll be very much reacting to the next set of inflation, unemployment and wages data.
I guess the only thing certain is that there will be more rate rises before too long. You saw there the cost of living outstripping wages. That will obviously have an effect, this interest rate rise, on people's household budgets. What could this change do to mortgage repayments for borrowers?
Yeah, look, mortgage repayments are definitely going up, way up, especially when you look at this next table. So according to these figures, assuming you have like a $1 million loan, if there are, say, 5 or 6 more rate hikes this year and the cash rate rises to 1.75%, then that borrower will have to pay an extra $885 per month. And let's say at the end of next year, if the cash rate hits 2.5%, then that person would have to pay an extra $1,300 per month, Casey. So it'll have a big impact on household budgets, and consumers are likely to cut back on spending, and that will lead to slower economic growth. And on that point, I'd like to emphasise that the Reserve Bank is caught between a rock and a hard place. So this graph here shows the level of debt in Australian households compared to their disposable income, and it's at record levels, and Australia is amongst the highest in the world, far higher than every other country, the debt to income ratio. So even a small rate hike will put a lot of pressure on Australian household budgets. But the silver lining is that the household savings ratio is at 11%, so that's very high by historical standards. So a lot of economists reckon Australian consumers should be able to withstand these rate hikes. But the RBA did put out a pretty dire forecast earlier this year, saying that if it were to hike rates by 2%, that could lead to a 15% drop in property prices over a couple of years. Now, a lot of economists do reckon that is overly pessimistic, but one thing they can all agree on is that property prices are on the way down, especially in the big markets, the most expensive ones, Sydney and Melbourne. And I guess the trouble the Reserve Bank is facing is it has to hit a sweet spot. It has to hike rates aggressively enough to bring down inflation, but not too aggressively that it causes an economic downturn or recession, which is a predicament the US is facing.
I guess you've got people who have bought houses at record high levels, with record low interest rates, and we may see some issues there with the amounts of debt some people are carrying.
Yeah, absolutely. So, look, I guess people, first home buyers who just scrape by to get into the property market, they're the ones who are expected to be hit hardest, especially if they bought in what looks to be a market that's already peaked. So, let's say that they, spent big money on a house in Sydney and Melbourne, the two most expensive markets, and prices are dropping. So they're taking out loans that are now probably more expensive than their property value. So they're in negative equity. So, there are certainly people in that situation that may not be in the best economic position.